down the moment something like this hits again. Subscribe. These rule shifts don't come with warnings. And for my last question, tell me straight, do you trust the screen price or the real world price more? It happened again. Silver didn't fall because the planet suddenly discovered a new ocean of supply. Silver didn't fall because solar factories shut down or electric vehicle demand vanished overnight. Silver fell because the rules changed. A margin hike hit the futures market this morning and it forced liquidation that was fast, ugly, and automatic. Last week we saw silver run into the mid-80s. Then, right as traders came back from the weekend, the exchange increased the amount of cash you must post to hold certain silver contracts. If you were long with leverage, you woke up owing more collateral immediately. You either pay it or your broker sells you out at whatever price the market will give in that exact moment. That is what happened. It isn't a mystery, and it isn't a macro shift. It's a margin squeeze. Welcome back. In this breakdown, I am going to show you the mechanics that cause this drop and the pattern that keeps repeating in silver. We'll look at why the paper price can move so violently even when the physical market stays firm, and what signals actually matter next. Before we dive in, do me a quick favor and subscribe. If you want clean explanations when the next wave hits, you'll want those alerts on. Now let's strip away the noise and go straight to the trigger. A silver futures contract is a leverage tool. One contract represents thousands of ounces, but you don't pay for all those ounces up front. Instead, you post margin a fraction of the full value as a performance bond. It's the exchange's way of saying, prove you can survive the volatility. When the exchange raises margin, it changes your required cash overnight. Your broker then recalculates your account based on that new requirement. If you don't have enough, you get a margin call. And if you can't meet it quickly, the broker does not negotiate, the broker liquidates, period. Now multiply that by a crowd. When thousands of leveraged traders are forced to sell at once, you don't get orderly price discovery, you get a stampede. The sell button isn't being pressed by conviction. It's being pressed by necessity. That is why these drops look like cliffs. A normal pullback has buyers stepping in and sellers testing levels while the price breathes. Forced liquidation doesn't breathe. It falls until the forced sellers are done. The timing matters here, and it always matters. This margin increase hit during a thin year-end stretch when liquidity is often lighter. Lighter liquidity means the same amount of forced selling hits twice as hard. It means stop losses get triggered more easily. It means a cascade can build faster than people can react. Here is the first lesson. In silver, you aren't just trading the metal. You are trading the rules around leverage. Most people learn that the hard way. Let's get more concrete, because margin sounds like a boring footnote until it reaches into your bank account. There are usually two numbers that matter: initial margin and maintenance margin. Initial is what you need to open a position. Maintenance is the minimum you must keep to avoid a call. When volatility spikes, those numbers can jump fast, and when they jump, they don't hit everyone equally. Big institutions can post collateral quickly because they have credit lines and treasury desks that move money in minutes. Smaller retail traders usually can't. Most people can't wire fresh cash instantly, especially during a holiday stretch when banks are slow. So the market doesn't liquidate the wrong crowd first, it liquidates the least liquid crowd first. That's why these events feel unfair, because structurally they are, watch the chain reaction. The price dips and that dip trips stops. Stops become market sells, which push the price even lower. Lower prices trigger more margin stress, which forces more liquidation. It's a self-feeding spiral. In the futures market, that spiral can represent an absurd amount of paper ounces trading in minutes. It's not because that much metal moved, but because that many paper claims moved. Since the futures price is the benchmark, those claims drag the screen price lower even if the physical market is unchanged. You can have a world where the chart screams downward while the real-world sourcing stays tight. That isn't a contradiction. It's just how the market is built. Structure doesn't win forever because physical reality is the ultimate judge. If the paper price drops far enough below physical reality, two things tend to happen. Buyers with real cash step in, and arbitrage starts sniffing out the gap between paper and physical. It doesn't always snap back instantly. Delivery rules, vaulting, and financing slow the process, but that discount becomes bait, and that bait attracts the people who matter most, end users and deep-pocket accumulators. This leads to the question that follows every margin flush. Did today's forced selling hand a discount to the exact buyers who need ounces, not opinions? Because if it did, today's crash can quietly become tomorrow's rebound. If you trade leverage, your only defense is slack. Don't run your account tight, and don't assume today's margin is tomorrow's margin. Assume it will jump when it hurts the most. If you don't have room for that jump, you don't have a position, you have a timer. The official explanation for margin hikes is risk management. The exchange wants to reduce default risk when volatility rises. That explanation is real. Exchanges have to protect themselves. But here is the second lesson. risk management and price impact are not separate things. They are the same action with different marketing. Raise the margin and you reduce buying power. You force positions to close and you change the flow, which changes the price. Silver has a habit of seeing this tool used at the most sensitive moments. History is the warning label that nobody reads. Silver goes parabolic, then the rules tighten. Restrictions and margin changes hit and the rally breaks. The story then becomes a cautionary tale rather than a scarcity story. We saw this in the post-crisis era when silver ripped toward its highs and margins were increased repeatedly in a short window. The move reversed hard. Now in late 2025, silver surges again. Margins were just raised more than once in the same month, with the latest increase taking effect while the market is thin. Is that proof of a conspiracy? No, I'm here to explain incentives and mechanics. If the market is heavily short by big institutions, a sharp rally hurts them. A margin hike that forces long liquidation relieves that pressure and creates a window to cover. It buys them time. This doesn't require a grand plot. It just requires basic human behavior. When you are under stress, you want relief. So ask yourself, when a wave of forced selling hits, who benefits first? The forced sellers lose control and the buyers with cash gain it. Let's read today's action like a forensic report. The key clue is speed. Real fundamental shifts don't usually happen in 15-minute avalanches. Physical demand doesn't evaporate during a coffee break. Mines don't triple their output before lunch. But paper can move that fast because paper is just a claim. Claims can be created, traded, and dumped at the speed of algorithms. This is why you must separate the paper price from the physical condition. During margin flushes, the paper price drops and social media panics. But when you look at the physical market coins, bars, and wholesale premiums, it often doesn't follow. Sometimes premiums even widen because buyers rush in to scoop up discounted metal. That divergence is a signal. If silver truly became less valuable overnight, physical sellers would be undercutting each other to move product. Instead, we see firmness, which tells you the world isn't rejecting silver, leverage is just getting purged. This purge matters because it transfers ownership from weak hands to strong hands. It moves exposure to cash buyers and industrial end users. A margin crash is terrifying because it's violent, but it's constructive because it clears out unstable positions. Today's drop might not be a trend change. It might be the purge before the next leg up. Silver has a unique talent for teaching the same lesson every few decades. In 1980, the price didn't just decide to reverse. The rules tightened into the rally and forced the exit. In 2011, we saw a sequence of margin squeezes that added fuel to every drop. If you know the map, you stop being surprised. If the physical market stays tight, the market can split. You get a paper price shoved around by rules and a physical price that stays stubborn. When that split gets wide enough, it forces a resolution. Either paper rises to meet physical or physical availability dries up and premiums explode. Both outcomes are the opposite of what today's headlines imply. Don't let one margin memo rewrite the bigger story. Silver is a strategic industrial input. Solar, EVs, data centers, and the grid upgrade cycle all have silver embedded in their hardware. Demand isn't a meme. It's structural. Meanwhile, supply is slow and often a byproduct of other mining. When the world consumes more than it produces, the system becomes fragile. In a fragile system, paper events become more violent because there is no cushion. Does this mean the rally was fake? No, it means the rally was leveraged. The real question is what happens after the leverage is shaken out. Watch these 4 signals: physical premiums, inventory levels at major warehouses, delivery behavior, and global price alignment. If you were leveraged, you just learned an expensive lesson. You can be right on the fundamentals and still get destroyed by the mechanics. The banks don't need you to believe silver is dead forever. They just need you to panic long enough to sell into the hole. Don't anchor your brain to one day of price action. A margin hike didn't create more silver in the ground, and it didn't erase industrial demand. It changed collateral rules. That's it. Expect more volatility and attempts to shake your confidence. The disciplined buyer watches the constraints, not the candles. I am not telling you what to buy. This is education, but I am telling you what today actually was. It was a rules event. In a small, explosive market like silver, it doesn't take much forced selling to smash the price, but it also doesn't take much real buying to send it flying. The next chapter will be written by physical signals, not by the loudest headline. If you want the next breakdown the moment something like this hits again, subscribe. These rule shifts don't come with warnings. And for my last question, tell me straight, do you trust the screen price or the real world price more? It happened again. Silver didn't fall because the planet suddenly discovered a new ocean of supply. Silver didn't fall because solar factories shut down or electric vehicle demand vanished overnight. Silver fell because the rules changed. A margin hike hit the futures market this morning, and it forced liquidation that was fast, ugly, and automatic. Last week we saw silver run into the mid-80s. Then, right as traders came back from the weekend, the exchange increased the amount of cash you must post to hold certain silver contracts. If you were long